It's an interesting one because usually the economists are the pessimists, the traders are the optimists. It's been that way for most of this rally, but there's a bit of a reversal here. Traders focus on the bad news coming from earnings reports, while economists keep their eye on essentially upbeat economic data. Here's our econ bulls versus market bears. And take a look at the graphic there. That's done by our graphic artist, Lynn. I'm trying to think who has the upper hand. The bull has the high ground, but the bear looks pretty well positioned to defend him or herself in this situation there. But on the left, earnings is a positive. Earnings are a positive.
At least current quarter.
According to our buddy Juan, who does our earnings here, the actual reported are 25% up
but it's the
year over year.
Outlook that is shaking things.
The outlook, absolutely. GDP, we're probably going to do 3% for this year. We're 3.3 or 3.2 on the third quarter. Going to do probably another 3 in the fourth quarter. Unemployment 3.7, falling. Inflation very well contained. Go over to the right side. Tariffs, a big question mark. We don't know how much that's going to be negative for the U.S. Certainly, there's a possibility of negative for the some of the S&P 500 companies. Housing and autos, two interest rate sensitive sectors, and then the Fed essentially seen as a negative here by most in the market. So let's take a look now at the S&P 500 by sector. And since the top of the market on October 3rd, and it does look a little bit like an economic slowdown trade. You've got utilities and consumer staples are your best performers. Go to the bottom there, energy, materials. I'm sort of surprised, IT, but maybe, Mike Santoli, this is a sort of normal thing that the first time, when they sell off, this is what they do.
It's obviously global cyclicals are the bottom performers, right? So I do think the one thing you have to maybe bring up when you talk about reconciling the economist versus the market is the earnings stream of the S&P 500 is pretty global. So it's not just necessarily a thumbs down on how the U.S. economy looks when stocks sell off.
Yeah, but the counter argument to that would be that the Russell 2000 is immune from all these downturns, and
but it's
the
not.
Russell 2000 is in correction territory.
It's lower quality, more leveraged companies.
I will say
a lot of financials.
It's worth remembering 2017 growth in the U.S. got a pop from unexpected growth overseas, and I think the market didn't then sort of account for the idea that the globe slowed down at least more towards normal. Both sides agree a slowdown is coming, as kind of Becky mentioned right there. Economists generally see the effects of the tax cuts wearing off next year and the year after, though they debate how much. And stock watchers know that as much as half of current earnings gains could be from the tax cut. And that's where the debate is, where earnings growth goes next year. The guys who say
just because of the comps, trying to go up against tougher comps.
Yeah, I mean, everybody knows it comes off, and I don't think that's a factor, right? You don't say I'm not gonna count on another 20 next year.
No, but you're still dealing with lower taxes that you're going to be paying. It's just it doesn't.
The comps. It doesn't comp again.
Yeah.
Right. And then what do they do with that tax cut? Does it lead to the cap investment, the productivity story? But I think that debate is between, are you a fiver or a tenner?
What?
Are you a 5% growth guy? In other words, we go back from 25 down to 5, or do we go from 25 down to 10?
What if it's 8?
Well, you tell me.
Well, I'm not going to tell you.
I think 8's pretty good. I think 8's pretty good. I think 5 is the one that would be disappointing.